In early 2019, Midwest BankCentre's started offering its customers the ability to open accounts online using Mantle's platform. Now around 20% of new accounts are opened digitally. Today, you'll hear more about the St. Louis-based bank's digital journey. Thanks for joining us. I'm Emily McCormick, the Vice President of Research at BankDirector. I coordinate and execute our research projects, including our annual surveys and ranking banking study. I also write for BankDirector Magazine and BankDirector.com. Today's webinar is brought to you by both BankDirector and Mantle. As an information resource to the financial community, BankDirector focuses on the strategic issues most fundamental to bank executives and board members. Mantle's account opening software helps community banks and credit unions grow deposits faster, increasing conversion rates and creating an elevated customer experience. Before we get started, I have just a few housekeeping items to review. First off, don't worry, we can't hear you. You've joined this webinar in listen-only mode. We do recommend that you click on the slide bar at the bottom of the screen to put the presentation into full screen mode. If you have any questions for our speakers, just note those by clicking the Q&A button found on the right-hand side of your screen. You can do this at any time during the presentation, and we strongly encourage your questions. Once our presenters have finished with their talking points, we'll have a Q&A period and we'll address as many of those questions as we can. There's no need to take detailed notes. We will share the presentation with all attendees within 24 hours via email. You'll also be able to find it on BankDirector.com, Mantle.com, and MidwestBankCenter.com. If you have any technical issues, you can note those using the moderator chat feature that is also on the right-hand side of your screen. And finally, the opinions expressed in this webinar are those of the individual speakers only and do not necessarily reflect the opinions of the other speakers or of the entities with which the speakers are associated. So with that, just a few items to share about our speakers today. Erin Earhart is an Executive Vice President at Midwest BankCenter, currently heading operations along with mortgage and fee services. With her team, she's worked to create products, services, and resources that empower people and small businesses. Dale Oberkfell is a longtime community banker and president and CFO at Midwest BankCenter. He's also served on the boards of nonprofits focused on children and youth development around St. Louis. And as I mentioned, Erin and Dale both join us from Midwest BankCenter, which has served the St. Louis community since 1906. Finally, Raj Patel is the co-founder and CFO of Mantle. A serial entrepreneur, he's founded and invested in several startups before founding Mantle. He's also held positions in investment banking. So with that, Erin, Dale, Raj, take it away.
Thank you so much, Emily. It's a pleasure to be with you all. I thought what we might start with today, we've got a sort of long agenda of items that will hopefully be very interesting for the audience, particularly the community bankers in the audience, is to start with a little introduction, a little bit more of an introduction to Midwest BankCenter itself. It's quite an interesting community bank with a long history. So Dale, I wondered if you could just give the sort of the viewers and listeners a little bit more of an overview of your institution and how you do business in St. Louis.
Yeah, sure. Thanks, Raj. Happy to be here today, and thanks to BankDirector. We are over 100 years old, primarily in St. Louis. Our brick and mortar branches are all in St. Louis. As the introduction described, we actually started opening accounts online in a new brand called Rising Bank in February of 2019. Our goal was to engage different age demographics, different geographies across the country, and we marketed it to all 50 states. Today we have accounts in all 50 states, and the experience has been extremely positive. In addition to just opening deposits, it is our goal to engage our customers both locally and at a distance with digital first technology. And so what that means is build out both sides of the balance sheet to help our customers engage at the points that they desire to engage, whether it's 2 o'clock in the morning whether it's 2 o'clock in the afternoon, if they want to walk into a branch, whatever their desire is, we want to meet them and meet that expectation. So it's really been an interesting journey with the Mantle experience. And so why don't I hand it back to you, Raj, and we can talk a little bit about that.
Yeah, perfect. Thanks for that, Dale. I think one of the most common questions we get asked, and I think is generally around anything to do with digital, is I think a lot of institutions in the audience have probably heard from their peers or maybe experienced themselves doing some digital initiatives and not necessarily seeing the volume or results against those initiatives. There's preconceived notions certainly in the industry and challenges to adoption. How did you all at Midwest Bank Center sort of get over that hump and make the decision to kind of start the journey on these digital initiatives, both for Rising Bank and then now subsequently for Midwest Bank Center, to kind of start justify that ROI when you first started?
Yeah, so Dale, if you want to start with the Rising Bank side of things, since that's where it kind of began, and then I can speak to the Midwest Bank Center side.
Yeah, sure. So again, we're a digital first, customer centric, value added bank. That's our strategy. And what we're attempting to do is we're attempting to create the technology and the efficiencies to go from a $2 billion institution to a $3 billion institution as efficiently as possible. And so technology has advanced significantly over the last 5 to 10 years to help allow that. And so for us, it's really about creating that efficiency and testing that technology in a way that is a pure laboratory type of environment. In Rising Bank, it's digital only. If a customer wants to walk into one of our branches in St. Louis, we don't do Rising Bank transactions at a teller counter. Everything is done electronically, statements. They can call in. We have an 800 number that is manned most of the day and night. And then of course, we use Jack Henry and Banno conversations to communicate in a secure way and transfer information between the two of us. So it has been very effective, and the customers have embraced it pretty significantly. So the goal is to start potentially on the Rising Bank side, which we did with Mantle, and then migrate that capability to the Midwest Bank Center side, the brick and mortar side, which we did with Mantle late last year in the middle of the pandemic. So I will let Aaron talk about that rollout of both Banno and Mantle last year.
Sure, thanks, Dale. So obviously, as Dale mentioned, we started with Mantle with Rising Bank, which is our digital only brand, and then always had the intention of offering that to our Midwest Bank Center customers as well. We are a Jack Henry bank, and so had leveraged Banno, the online banking platform, for Rising Bank when we stood that up, and obviously needed it for the Midwest Bank Center side as well. And so there was a little bit of a delay on that project, but once we were able to get that up and running, standing up Mantle for Midwest Bank Center was a quick follow. And so to Raj's question, getting customers to embrace that, what does the volume look like? We did have I suppose this might not be the right way to say it, but the timing was good, right? So we had the benefit of the fact that a lot of people weren't coming into our branch lobbies. And so we were able to market it pretty effectively to our existing customer base. And by the beginning of 2021, we've consistently been opening more accounts online than in our branches. So not collectively. So if you took all of the branches and added them up, it would slightly exceed what we've been able to do in the online account opening space. But month over month, the accounts opened online actually exceed our largest flagship location accounts opened. And so that's a pretty consistent trend. And so the adoption's been pretty strong. The branches at that time, because the lobbies were by appointment only, they were easy to get to adopt sending customers that path as opposed to inviting them into the lobbies. And so it was actually helpful, the circumstance that we were in, and engaging it at that time.
And Aaron, just following up from that, and I know you and I have spoken about this before, and it's something I've certainly heard from other community banks. Often, from a retail perspective, adding an online capability might be seen by some socially as competitive to the incentives for individual branches. Obviously, the pandemic was helpful in sort of driving that adoption. But how did you think about, approaching that from a cultural perspective within the bank?
Yeah, so we were pretty intentional. So like most retail banks, there is a compensation structure in place that includes an incentive plan based on performance. And so we were pretty intentional this year with making sure that compensation for new accounts was primarily based on referring customers to the online platform as opposed to doing those in branch. When we reevaluate those on an annual basis, we're pretty consistent with making sure they align with what our goals are as an organization overall, and really trying to drive customer that digital channel path. And then also, obviously, with deposits being the way that they are right now, lending is a focus as well. And so we were able to pretty nicely tie up their incentive plan to really align with engaging in those, as opposed to bringing customers in and sitting down and using the old way of doing things. It's actually worked out really well. And of course, if customers want to come in still and sit down and have that conversation with a banker, we're a community bank, and we're very happy to serve them in that way also. But it did give them a little added bonus to tell people about the online account opening as well.
Yep. And because you started sort of with that digital only brand, and that was kind of run sort of as a little incubation, and obviously the success of that has now translated over into the more brick and mortar, was there a level of excitement within sort of the rest of the bank to kind of adopt some of that technology? And I know now you now oversee both areas of the bank, both sort of areas of the bank, which is quite interesting from a like a cultural change perspective.
Yeah, so technology has been something that we've talked about for quite a while, something that we've been asking for. And, once we got going, we continued to move pretty quickly. So there was excitement around that. It's something that customers had been asking for a while. So between, having the enhanced online banking experience through Banno, having the online account opening capability. And when we say online account opening capability, so at one point we had started to look at another vendor, and it was really just taking the somewhat clunky account opening and branch process and just putting it online. And so I think that the ease with which people could open accounts through the Mantle platform was something that was very exciting for them as well, because you really had to think about it a little bit differently, right? So we're not getting their driver's license, we're not having them sign signature cards. And so I think that they were pretty excited to embrace that and see us looking at things a little bit differently.
Nice. So transitioning over a little bit to 2021, I think that, the sort of how you thought about deposit strategy when you were first putting Mantle in place a couple of years ago to the world as it is today, and deposit strategy in 2021 is very different. I think, maybe this one's, best for Dale in the initial conversation. The deposit landscape has obviously changed. How are you changing, or how have you changed the strategy, over time to respond to that? And how have you used the technology and the systems and the channels to kind of respond to the different rate environment?
Yeah, I'll take that one, Aaron. It's interesting because we did not design Rising Bank and the digital strategy to be only channel that ultimately survives. That's really not what a community bank is. Community bank is about talking to the customer, knowing the customer, and taking care of those questions. And so we look at it as just another channel. On our system, we call it branch 46. Okay, it is a way to raise deposits. we are working on ways to make loans. We have, since we've done the original deposit rollout, we've added checking accounts, we've added Zelle, we've added Blend for mortgages. We use Blend on both sides of the bank. We have added an insurance portal, which we also have on the MBC side. So many of the things that we're doing, we can learn how to use it first in the Rising Bank brand and in that space, or we have had some that we've started on the MBC side and migrated it over to Rising Bank. But our goal is to build that capability digitally on both sides of the balance sheet. We are we're very close to rolling out our first non-mortgage loan with an online provider that is helping us do that, both in our white labeled MBC logo, and then a couple months after that we'll have it in Rising Bank also. So this effort is really an effort to try and take the advantage of the technology. When we look at this technology, it's about letting the customer in the front door, so to speak, through the portal, and then letting the technology drive you all the way through so that it drops it straight into the Silver Lake core, which is what Mantle does for us. So when somebody comes into the Mantle portal, into our online portal, basically Mantle in less than 3 minutes goes through the 6 questions that are asked. We identify those people through KYC, and we approve it 95% of the time. It drops straight through to the core. There are a number that are automatically declined for various reasons, and then there are a few percentages that we have to do manually. But the improvement is significant because we do that with 2 FTEs, and since the pandemic has started, we've basically just been treading water. So I think it's important to think of it as another channel, and right now that channel, because of the bloating of all the community banks' balance sheets with deposits, that channel is the most expensive channel we could acquire deposits in. So we've been treading water basically since the pandemic started, and that's just fine. If we lose a few dollars from a retention standpoint, we fill those dollars back up and average down those cost of deposits like everybody else has been doing across the country. So it's been really good, actually. We've not been acquiring additional deposits, but we have been adding more products and services to the Rising Bank side of the house and to the MBC side. So, the pandemic has. Sorry.
Sorry, Dan, I was going to say, would it be fair to say, and I think you spoke about some of those, sort of lending initiatives that you're doing, would it be fair to say that, the rate environment and the NIM compression has accelerated your plans on the asset side of the balance sheet?
Yeah, I would say just the environment in general has accelerated our speed because the pandemic has taught everyone that change is not bad.
Right.
In other words, we had to go to a remote work environment. We closed our branches. We taught our customers that they had to do business a little bit differently. We taught our employees they had to. So the world has become more open to change, which in our world, from our perspective, we're speeding up that change as fast as we can. And therefore it has a higher acceptance than maybe it would have had prior to the pandemic.
And just tagging off from that, Aaron, I think now that the world is sort of opening back up, and based on your experience in the pandemic and sort of the adoption you've seen online, I think there's a lot of speculation in the industry about what the go forward is going to look like, right? And we know certainly from industry statistics that the mega banks, the Chases and Wells Fargo's of the world, et cetera, had been for a very long time opening over 50% of their consumer relationships online and not in their branches. And in community banking, it was more at the sort of 5% range. And I think a lot of community banks have seen somewhere between 5 and 50 over the last year. And you've obviously seen, sort of very significant numbers. What's your view from the retail perspective on the go forward? What do you think consumer behavior is going to be, and what are you looking for from NBC for the rest of the year?
So to be very honest, we're interested to see what it does end up looking like. So our lobbies are reopening. They're the customers that really were disappointed that they couldn't come in, and I think that some of those customers were really just coming in more for socialization purposes. It wasn't necessarily banking need driven. Some of our commercial clients, though, that were a little bit more cash deposit heavy, they are happy to be back in. It was a little easier to do it that way than through the drive-through. But we think that we'll see some of those that used to be frequent lobby users come back into the lobby. But we think that a lot of people are going to continue to use the digital channels that have been made available to them or that they've tried during the pandemic. Towards the end of last year, we actually surveyed customers just to see how they were feeling, right? So, were they feeling like it was hindering their ability to bank with us by the lobbies being appointment only, or had they tried some of the digital channels, or, were they really okay with going digital and not coming back into the lobby? And the vast majority were okay with it. And a lot of people that hadn't engaged in those channels previously were adopting them. And so it did place us uniquely. But I think that, we'll see some people come back in, but I think that a lot of people are going to continue to bank the way that they did during the pandemic from an online and even to some degree drive-through ATM perspective.
Yeah, and I think I think we were chatting recently, and you were telling me that in the data, what you've started to see is that previously you were thinking about the geographies that a branch might serve in the sort of 3 to 5 mile range, and what you see with the new digital capabilities is that geography has expanded a little bit. Do you mind talking about that? I think it's really interesting.
Yeah, so it actually has started expanding. And Dale, I think you were a little bit closer to that data than I was. So if you want to expand on that, that'd be great.
Yeah, sure. A lot of businesses, not just banking, have really started to evaluate, doing business, brick and mortar versus online, and so they describe it as a halo effect around your brick and mortar branches. So 3 to 5 miles was the typical geography that we looked at when we thought about planting a new branch, and we needed enough housetops to be able to acquire the deposits over a reasonable period of time, 3 to 5 years typically, to break even and make some money. And so today that has expanded because of the digital presence, digital capabilities. Fewer and fewer people are coming into a branch to do the basic transactions, and they're using their technology. They're using their cell phone, they're using online banking, they're using Zelle, they're using Venmo, they're using all these different capabilities of pushing money around, and that doesn't require them to walk into a branch. And so I think what you're going to continue to see is that, and it's already been seen certainly in the biggest banks, where some branches are going to close. They'll realign branches within communities, and they're going to take advantage of that halo effect of a digital banking. And I think that will result in fewer branches in various locations and smaller branches. And so I don't know how long that'll take, 5 to 10 years, but it has already started. And I think that, again, it's not just a banking phenomena. It's in a lot of different retail industries also.
Right, yeah. Number of physical retail stores in America has been falling, just like the number of bank branches has been falling since the global financial crisis year on year. Certainly a trend accelerated by the mega banks, who I think are probably a little bit further along on the digital adoption curve and sort of started seeing this data earlier. And as you can imagine, they've been closing more quickly than community banks, but it's really interesting. I think that, would you say, and I think there's kind of something really important there, is you talk to me a lot about your digital channels, both the Rising Bank side and the NBC side, as they're a branch. They're a branch on your core. You report them as a branch to your regulator. On your deposit summary, they're a branch. You think about them from an economic perspective as akin to another branch. And so I assume that the economics need to stack up there. But it sounds like what you're saying here is it's also making your other branches more valuable.
Yeah, I think it gives you the electronics gives you the ability to have a more consultative relationship with customers when they come in. In other words, if they're not going to do basic banking transactions, cash a check, make a deposit, things like that, then they're going to walk in for other reasons. They have a problem to fix. They need a loan. They need some help with an issue that they have financially, and so we have to be better at that choreography when they come into one of our branches, and so we have to be more well educated to help them with their problems, and not just cash checks and things like that. Where when back in the day when I first started in banking, every Friday the bank would be deluged with people coming in and cashing their paychecks. Well, we're busy on Fridays, but it's not anything like it used to be, and it will never be like that again. And so I think that's really what's changing the scope of the size and the importance of a specific location. So that's going to be really important as we go into the future.
And I think a lot of people talk about in the industry that they don't want to lose the core of community banking, which is what makes it special and so different from the money center banks, particularly that high touch model in the service. And it sounds to me like what you're saying here is the level of touch is actually not going down; it's going up. It's just changing the conversations that are happening with banks. And Erin, have you started to see? Is that kind of what you are seeing on the ground, or is that what you're expecting?
Yeah, so we've talked a lot about our focus on digital, but to Dale's point earlier, we really just want to meet customers where they are, right? So just give them the ability to bank the way that they want to bank. So we still want to have that community feel, that community touch. We want those conversations in branches to be a little bit more consultative, because at this point in time, a lot of times if someone comes into the branch, again, if they're outside of that group that comes in more from a socialization perspective, which is great, we love that they're coming in too. But if someone's coming in, that's great opportunity to further build that relationship, to have a more consultative conversation and really learn how we can help them. But if someone's busy or doesn't desire to come into the branch lobby, we want to be able to help them as well. And so I think it's really finding that balance between the high tech and high touch to be able to service our customers at this point. But yeah, that really is what we're seeing.
Yeah, it's really interesting. We've rolled out Rising Bank, right? And it was a sort of a proof point for the technology sort of nationally. We rolled it through Midwest Bank Center as we've spoken about. The bank is also working on lending activities across both MBC and Rising Bank. I guess it sort of begs the next question, which is what's next from an innovation perspective at Midwest Bank Center?
So it's pretty exciting, actually. So we are actually looking to stand up an SBA division that will operate under Rising Bank. And so from a deposit perspective, obviously looking to partner with Mantle to offer the online business account opening to support that. In addition to that, we also have an LPO strategy that we're working on. And so really looking to other cities across the country that are high growth markets that we might have opportunity to operate in from a commercial and mortgage perspective. And that will also, outside of the Midwest, operate under the Rising Bank brand. And so definitely puts that remote or online account opening, makes it a little bit more important. Dale's been working with, as he mentioned, Upstart to stand up kind of an auto refi that will operate under both as well, under both brands. And so pretty excited about that. So
that all sounds really exciting, but obviously requires a pretty significant level of investment. That's not just a few pennies. That's a lot of technology. And maybe this might be a good question for Dale. How are you approaching those conversations I think you have a board meeting later today. How are you approaching those conversations from a senior executive, in your executive management, but also at the board level? Because those are not those are not necessarily small investments. They're akin to building one or maybe a couple of different branches, right?
Yeah, so it's interesting, Raj. Over a fairly good period of time now, 3 to 5 years, let's say, we have been working on our efficiencies to go from, a paper environment. Banking was paper, and we're, totally imaged. We've, like in Rising Bank, we've given up signature cards, we've given up driver's license. We're trying to do those things technologically, and so if you think about, Aaron mentioned a loan production office. So 15 years ago, if you did a loan production office, you'd have a loan production office, and if you wanted to acquire deposits of those customers at the loan production office, it was a challenge because, again, we were opening accounts with paper only. And so today, we can branch anywhere, so we really are not restricted by that. But the question is, do we really need to branch? And so today, that halo effect that I mentioned about a local geographic area really expands to the entire country. And I like to explain it again. When kids used to go away to college, their parents would tell them, now you go and open up a bank account so that when I send you a check, you can deposit it and you can go and get some cash. And so today, there's absolutely no reason why a young person has to grow up and if they move away to a different city that they have to change their banking relationship. We want them to stay with us from a banking relationship standpoint. So that is a driving force for us to engage this digital effort so that we don't have to plant branches all across the country to be competitive, because that is expensive. Brick and mortar is very expensive. And as hard as you try, you never hit 100% of accuracy or success when you open a branch. And so when we rolled out Rising Bank, we compared opening up Rising Bank to what's the cost of opening up 10 brick and mortar branches, because we felt that we could open $100 million in accounts annually. And so what would it take to do that in a brick and mortar world? And so clearly it's much more efficient and cost effective to do things digitally if you can do that. So when you think about that lift, that cost, it is actually less expensive to engage customers digitally in almost every transaction opportunity.
So it's really, I think there's a couple of really interesting points there. I mean, I think the first is that you compared a technology expenditure with a physical expenditure or investment, right? Which is, it's not necessarily an apple with an apple, it's an apple with an orange, but you did that, right? And presumably you also looked at it compared to other uses of capital, whether it was buying back your stock, paying down wholesale funding, whatever it happened to be as well. So you basically use a traditional investment lens on the expenditure. What I often hear in that analysis is banks are very good at looking at what it costs, what's the ROI of a branch. It's very well understood. They have a long operating history of opening, closing, buying, etc. branches, and they understand deeply the economics of branches in their local communities, as you expect. What we often hear is they don't know how to assess the output of technology. They know what the cost of technology is because your vendor can provide it to you, but they don't have a good sense of what the likely outcome of the technology investment is going to be versus what the likely outcome of a branch is going to be. So how did you go about thinking? You said, Rising Bank, $100 million a year. How did you go, or what Midwest Bank Center, right? The sort of in market production that's delivered out of Aaron's team. How did you go about sort of quantifying what that would be, for the R component of ROI?
Yeah. So it's an interesting question because we looked at this as an opportunity to grow deposits. We we've had a good loan growth from the commercial side of the house.
Mm-hmm.
Historically, over the last 20 years, our loans have been 80% commercial, 20% consumer. And so we really want to change that up to be more consumer and more efficient from even a small business commercial side. So when you think about expanding and you think about scale, you can't scale with bodies. You can't scale with more employees efficiently. And so for us, it was about looking out into the future as to what we wanted to be and what were our choices to get there. And so when you kind of have a future state in mind, it makes it easier to bridge that gap between point A to point B. What I believe some community bankers have a problem with is finding the right reason for doing online capabilities. In other words, if all they want to do is use it as a defensive posture, that's great. They can use it as a defensive posture, not have to spend as much money, but at that point they can't expect the same digital engagement because they really haven't committed the funds for that activity. It's not bad. It's just what their strategy might be. So I think the biggest challenge for everyone is to figure out what they want their future state to look like, and then when they have that goal in mind, then you can actually build the highway. How do you get there? You don't start with everything all at one time. Rising Bank, we started with savings accounts and CDs. And so we had a roadmap of products and services that we've wanted to add, and we will continue to add, and we'll continue to add it on the MBC side also. So as we learn this digital exercise, it's going to make us be more efficient across the entire bank, not just one digital branch. And so I think it's really setting that long-term goal and understanding what's achievable and what's not achievable. And so we had very specific goals in mind as far as how the marketing funnel worked, which Mantle helped us build, and so we knew what we should expect through that marketing channel. In other words, we threw people into the top of the funnel. Did they actually fall through and fill out the application and fund their account and become a customer? I mean, it's a very challenging effort, and if you're committed to it, it can be very rewarding, and I think so that focus is really important up front.
And Dale and Aaron, I think I know the answer to this question, but the original nugget of an idea to start digitizing, was that something led, from the executive team, like Dale, from yourself down, or was that something that came up as an idea through the digital capabilities at the bank or through the retail sort of division at the bank? Because I think there's a lot of people on this call who aren't necessarily the president and CFO of their
right.
institution, or maybe they have a president or a CEO or a CFO who has a slightly different view of the future and digital capabilities. So I think what's really helpful is understanding how a lot of the executives on the phone, maybe they want to pursue something like this, but how they can affect that change internally.
Yeah. So Dale, I don't know if you'll brag on yourself as much as you probably should on this one. So I will start it for you and then obviously follow up however you see fit. But I've been with Midwest Bank Center for a little over 5 years and started working with Dale pretty quickly when I started with the organization. And even from that point, so a couple of years before we even started Rising Bank, he was drawing this chart that showed us, who has all of the cash, right? It's generally the older population. But, what's the longevity of that? And unfortunately, the line tapered off pretty quickly. And so, he had that vision of knowing that we had to find new ways to gather deposits before I think a lot of people were looking at it as seriously as he was. And so, he was a big advocate of that. He definitely pushed us to try to find new ways to look at things. and really pushed our partners at Jack Henry to help us find a way to make all of this happen. But he was definitely the primary driving force behind pushing us to where we've gotten to now. And so, something that as an organization, we're very appreciative of, because historically it had been kind of I don't want to say sleepy, but just very conservative, very set in the ways that we did things. And his vision pushed us to look at things differently. And so we definitely wouldn't be where we are at this point if he hadn't done that and seen that. So.
Sounds like that's also been pretty infectious at Midwest Bank Center. Like yourself, Aaron, I know Joe in the BSA area, Marsha, obviously, a bunch of the executive team have really taken that torch on.
Absolutely.
Yeah, I think, Raj, that's what I'm talking about with focus. I take quite a few calls from bankers across the country, and I've learned that if I ask them to give me 10 to 15 answers if they ask me for a list of 10 to 15 questions that they're trying to answer, I can tell whether or not the bank that they're representing is really imminently serious about that effort, mainly because they might just let a marketing person make that call. The marketing person is coming from just the marketing space, and they're really not talking about what impact it has on IT and so on. So one of the benefits I do have from an experience standpoint is I've worked in banking for 40 years. I'm a numbers oriented guy. I know the IT side pretty well. And so that allowed me to kind of build that vision and build it in a way that helped us ride the rail of our core processor. If we can't control the costs, we can't exist long term. And so using the technology like Mantle that we've used, and we use Alloy for KYC, it's really helpful, because then we can drop it straight into the core and operate like we do every other account. And so I think that view, some people think it has to be truly different, but it really doesn't. And so that's where it starts, with the focus and everybody talking about how they can exert change. And I believe it does take executive sponsors to make that happen. And so I think, as people start thinking about maybe this activity, it is really about which executives are going to challenge their employees to make this happen. And I would say if you've got 5 executives, it's got to be at least 2 of the 5. And we used actually 3 of our executive team. We always said in the meetings, one of us has to be in the meeting so that we can make sure that our goals are continued to stay out in front of everybody. And so I think that's really important.
Yeah, it's definitely something we've seen from the vendor side, particularly working with Midwest Bank Center, but I can definitely validate it with other institutions we've worked with. When there's 1, 2, 3 executive sponsors that have a real strong interest in the success of the project, the right decisions, and sometimes the hard decisions, can be made, and a lot easier for them to be made by a senior executive than potentially other people in the bank. And so much of any technology deployment is about the decisions you make in how you implement and use the technology. It's not just what you buy, it's how you actually implement and use it. And I think you guys did a really good job, particularly of taking some of our best practices and listening to some of the data, and letting that sort of drive things and being open to change, which has really driven a lot of success. So I want to make sure that we have time to get to questions. I know we're sort of at about 15 minutes left on the session. So Emily, I thought if I could just hand it back to you, and we can absolutely take questions.
Yeah, we have some questions that have come in. So great timing, Raj. And if you're out there and you do have questions following this great discussion, we'll try to address as many as possible. It's definitely not too late to get your question in. if you want to try to sneak it in before we wrap up. So we'll just start getting through them. The first question we want to address references Rising Bank versus Midwest Bank Center and leveraging those two brands. And this person's curious if the user interface is completely different in terms of branding and features compared to the traditional bank, and whether there's two instances of the online experience. So if you guys could address that.
Yeah, I'll answer that. First of all, we because of our legal structure, we can only have one bank charter. Some people would say, well, why didn't you just do another brand with a new bank charter? And the answer is, first of all, that's a constraint that we have legally. We can only have one bank charter. So we had to design this with one bank charter, and the question is right on target, actually. The cores have not built their existence with multiple brands. So frankly, we have pushed Jack Henry to recognize that brand opportunity that's out there for other banks. But we do have two instances of Mantle. We do have two instances of Banno. And there are at least one or two other situations where we have instances of. So some of the fintechs have solved that question, and aren't don't create a problem with that. But it is a challenge, and I would say with the core, we run that brand all the way through. So our statements are generated with a different name, Rising Bank. We try to generate all of our notices with that correct name all the way down. There are some things built into the old infrastructure where some of the notices we had to come up with a common tagline to use for both sides of the house. So we had already started using a tagline called Rising Together. And so when we came up with the Rising Bank name, it really worked from a crossover standpoint. And so we will have some notices that go to Rising Bank that are headed up Rising Together, and some on the NBC side also that are headed up Rising Together. And so the branding is an issue that you have to sort out with your core. And some, I'm going to say this, and Raj, you can close your ears. Some vendors want you to pay twice for those instances, and others recognize the difference. We're one bank. Any other questions, Emily?
Oh yeah, plenty. Raj, this one's really more appropriate to Mantle, but I think tags along with Dale's comments nicely. Does Mantle fully integrate with the core?
Yeah, absolutely. So in Dale and Aaron's case, that was Silver Lake, as they've spoken about. But that's essential. Frankly, I think it's essential for any technology project at your bank, whether it's a Mantle technology project or whether it's in loans or anything else. I think immediacy in a client experience and also a banker experience is critically important. Batch processes are something that have obviously been the standard in the industry for quite some time, but that even in payments, that we're moving away from that. And immediacy is just so critical in reducing servicing costs and meeting client expectations that you need a real-time read and write capability everywhere you can get it. Getting back to the system of record, which is the bank's core, is critical for that. It is also what is required and necessary to do the right things on the risk management side, on the compliance and risk side, to be able to do the types of volumes that you want to be able to achieve online, right? If it's not in the core and in the system of record, then those other systems that also have integrations, those risk systems, can't see it. So it's just table stakes. Mantle won't do an integration that doesn't have a real-time read and write capability of the core, and we're very fortunate that we've done multiple cores across all of the three major core providers, and has to be a critical piece of expertise for any tech vendor in the industry, I think.
Well, let's follow that up with a compliance question. this came early on in your comments was in terms of not collecting that driver's license information and not having the customer sign a signature card. They're curious how you handle those functions. I would also tag on to that if you have any comments on the involvement of the compliance team, at Midwest Bank Center in working with Mantle to get everything lined up.
Yeah, Aaron, let me take the front end of this and you can take the back end. So, because I think when we implemented it, one of Aaron's responsibilities was the retail branch network. So one of the things that, again, I had concluded early on was that just think of it today. If you're Amazon and you're opening up a new Amazon account, do they require you to sign a signature card? Do they require you to show a driver's license? They don't. Now, they're not regulated, of course, but the real question is, a driver's license. Some employees of the bank, our bank, would say, well, that's required by regulation, and the answer is it's not. It is a tool that can be used for your KYC function. But what you're really supposed to do is do a KYC on your customer. And so the technology today is so advanced that with a few pieces of information, you can identify that individual is who they say they are with a high level of certainty. So, and actually, a higher level of certainty than walking in with a driver's license, because it's really not too hard to get a driver's license that has a different name on it. And so I think there's a misconception that you have to have a driver's license, and I think there's also a misconception that you have to have a signature card. So as an example, when we open up a checking account, if people want checks, that's fine. If they don't want checks, that's okay too. But if they use checks, then what we will do is we'll look for one of the first checks written on the account and capture that signature snippet and put it in our file. And so that's just a little strategy to have a signature on file, but it's not, it's absolutely not required. And so that was a pretty big hurdle, I think, up front in the beginning, because we had to kind of, make sure that we weren't going to talk about that. That was something we came to the meeting with. We said, this is table stakes for us. We're not going to ask for it. And so everybody needs to get comfortable with it. And if you can't, then we would ask you not to be on the team. And so that's a pretty interesting thing, because that's a question I get frequently from other bankers. How did you get over that hurdle?
And I just jump in before Aaron, just quickly. I'd just say this: you could go online right now and sign up for an account at Chase, Goldman Sachs, Midwest Bank Center, obviously, Capital One. You're not going to sign a signature card. You're also not necessarily going to put your ID in. Those banks are doing it too. The FFIEC guidance actually specifically says that you do not need to collect a document. You can do non-document-based verification. And of course, Dale and the bank have gone through many regulatory cycles with their primary regulator to validate that, and so is Chase, and so is Goldman Sachs. So it is a big misconception in the industry. Now, it is a bank-by-bank choice. So.
Right. And so, Emily, you had asked about compliance's involvement, and they were very involved throughout the process. And thanks to some of the strategic partnerships that Raj and Mantle have in place with some of their vendors that do some of that checking for us, based on the various metrics and data points that they looked at, we were pretty comfortable with it. Dale mentioned if they want to write checks, we'll take a peek at the signature on one of the first checks written. But quite honestly, what we have found is that people that are really engaging in that digital space, primarily, they're not writing a lot of checks. And they're doing a lot of their transactions online, again, to their point, all of which is generally going to be a little bit more secure than, someone walking in with an ID that they could have, had fraudulently created that says they are who they're not. So, in general, we were able to get there with them, and working through getting there with them in the small business space. But we're confident that we'll be able to get there. But they were very involved, and their input was important.
Well, let's shift a little bit on the commercial side really quickly. There's a question around the digital experience that you bring to your commercial clients. Where are you guys at Midwest Bank Center on that, and how do you see that evolving?
Yeah, so last year we installed nCino for the commercial customers. So again, it's really more of an efficiency play, because it really the loan operating system for the commercial really helps our back office probably more than our customers, but it helps organize that effort so that the customer can be taken care of very efficiently. We've recently signed a contract to install nCino for small business and consumer. And so sometime late this year, early next year, we'll have that in place. We'll be able to use both of those platforms for online account opening. We currently do not do that today, but it is our plan to leverage that capability with both of those platforms to start originating loans across the country with commercial and small business type customers. So yeah, it's again, when we say both sides of the balance sheet, really talking about both sides of the balance sheet, and where on our commercial side of the house, when PPP loans came out, for us it was all hands on deck, and we did 1,400 loans manually, and then by the time we came along with forgiveness and this PPP 2.0, we had technology in place to assist us with those efforts. So the 2.0 went much more smoothly and with less overtime than what we had on the front end. So we are motivated to respond as quickly as we can with a technology solution if it's available.
Now, what about the impact of your digital strategy on the retail staffing side? Have you seen impacts there? Has that resulted in reductions in retail staffing, or is it kind of shifting roles a little bit as you kind of talked about earlier in the discussion?
So I think from my perspective, it's giving them more time to focus on the customers that they are still servicing from an in-person perspective. There really hasn't been any resistance. They're excited about our digital first strategy and the technology progress that we've made. Again, I had mentioned that, we adjusted their compensation structure to reflect, getting the opportunities to the digital space if that was what was appropriate for that customer, and they've embraced it. So I think it's been good.
And I would add that, one of the fears that some employees have had when you say digital first is that, okay, they're doing this to cut people out. And so, this is not a cut people out strategy. I will admit there are some people who can't see themselves doing banking any other way than with a piece of paper. And if that's the case, that's fine. There's choices for them. The choice is they would have to go find a bank that's what they still do. And there's quite a few banks who do that. So that's fine. They can make that choice. And, but in our world, we want, if people want to learn what we're trying to do and utilize the technology, that's what we want. We want people who are willing to change, and people who can see an opportunity to help us change in their jobs individually is really helpful. So, we have, over the last 5 years, we've lowered our headcount about 10%. So we're down to about 270 employees today, when 5 years ago we were about 300. But it's really not, that drop has occurred through attrition primarily.
Yeah, I know I've heard that from a number of bankers with this digital experience. No one wants to let people go and let valued employees go. And there's been a lot of natural attrition, I think, that's occurred through the industry and as banks seek to continue to serve their communities. Well, with that, we're out of time, guys. So this has been great. As a reminder to everyone, you will receive the recorded version of this webinar within 24 hours. We'll post it on bankdirector.com. You'll be able to find it as well on mantle.com and midwestbankcenter.com. Raj, Dale, Aaron, I want to thank you all for a great discussion today. And thank you to Mantle for co-hosting today's webinar. And thank you everyone out there for joining us today. I hope you have a great rest of the day.
Thanks, Emily. Thanks, Raj.
Yes, thank you.
Yeah.